Over the past decade, the US stock market has been on a remarkable bull run. While many credit this to the innovative power of American tech companies, or the Federal Reserve's loose monetary policy, today I'm going to share a counterintuitive truth. America's decade-long bull market has largely been fueled by cheap money from Japan. This is what's known in finance as the carry trade, a classic interest rate arbitrage game. Recently, remarks from Bank of Japan Governor Kazuo Ueda sent market expectations for a December rate hike, soaring from 20% to 80%. In response, Bitcoin dropped 7% almost instantly. US stock futures tumbled, and the yen surged. Why would a potential rate hike in Japan send shockwaves through global markets? Because it could mean the end of a decade-long carry trade cycle. So, what exactly is a carry trade? In simple terms, it means borrowing in a low-interest currency and investing in higher-yielding assets. With Japan keeping interest rates near zero for years, international investors borrowed massive amounts of yen, converted it into dollars, and poured the funds into US stocks and bonds. According to the latest data, around 40% of Japanese households' 2,000 trillion yen in financial assets have flowed into overseas markets, with US equities being a top destination. The key to this trade is the interest rate spread. When US Treasury yields hit 4 to 5%, while Japanese government bonds yielded only 0.1%. That gap represented pure profit for carry traders. But now, things are shifting. Japan's 2-year bond yield has jumped to 1%, its highest since 2008. If the Bank of Japan actually hikes rates on December 19th, that spread will narrow sharply, squeezing the profit margins of carry trades. History shows that carry trade unwinding is never a gentle process. In December 2022, when the BOJ merely tweaked its yield curve control policy, global hedge funds lost over $30 billion in a single day. An actual rate hike this time would deliver an even greater shock. What's especially concerning is the timing. December 19th falls right before Christmas, when market liquidity is typically at its annual low. Any unexpected policy move could be magnified. Even more alarming, the current scale of carry trades is about 40% larger than in 2022. And much of that capital is concentrated in US tech stocks. If unwinding begins, heavily owned stocks like Apple and Nvidia could be hit first and hardest. At the same time, expectations around the Federal Reserve's policy have been swinging wildly. The probability of a December rate cut has swung from 80% down to 30%, then back up to 100%. Such uncertainty only adds to market fragility. Early warning signs are already flashing. Bitcoin, often seen as a barometer for risk appetite, suddenly plunged, while the yen strengthened rapidly. Both signal that money is starting to retreat from risk assets. If the Bank of Japan does raise rates in December, we could see even sharper market swings. This decision may well become a stress test for the resilience of global financial markets. If the hike happens, we might witness a textbook case of carry trade unwinding. For everyday investors, the most important thing is to stay alert and keep a close watch on developments. If you found this analysis helpful, please like, save, and subscribe. I'll keep you updated as this critical story evolves. Remember, in financial markets, understanding is more valuable than predicting, and risk awareness matters more than chasing returns.